Welcome to Earnings Recap. Today we're summarizing Netflix's Q1 2025 earnings conference call.
That's right.
What we're aiming to do in this deep dive is really pull out the crucial insights from that call for you. We're talking the financial headlines, where Netflix sees itself going strategically, and, how they handled some of the tough questions from analysts.
Sounds like a plan. Let's get started.
Okay.
So kicking things off with the big picture. Netflix is just operating at a massive scale, isn't it?
Absolutely huge.
Yeah, over $40 billion in revenue annually, and they've now cracked the 300 million paid household mark.
Wow.
Which translates to, over 700 million people watching.
Staggering numbers.
It really is. But even with those figures, the key thing management kept saying is they still see significant room to grow.
Okay, significant room to grow. That's interesting. Where exactly are they seeing that potential?
Well, they pointed specifically to engagement. Right now, their viewing only accounts for less than 10% of total TV time.
Less than a tenth.
Seriously. Yeah, think about that. That alone suggests this huge upside if they can just get people watching Netflix more.
Makes sense.
And they also talked about adding more subscribers, potentially hundreds of millions more households globally.
Ambitious.
And then, of course, there's advertising revenue. There's still, a pretty small slice of the total ad spend pie in the markets they serve. So lots of runway there, too.
That long-term view, that connects to that Wall Street Journal report, doesn't it? The one about doubling revenue and tripling operating income by 2030.
Exactly. Now, they were pretty careful to say that's more of an internal aspiration, not official guidance or a forecast.
Right, not set in stone.
No. But it definitely underscores the scale of their ambition. They're not just thinking incrementally. They want to fundamentally expand their whole footprint.
So while that 2030 number is maybe more of a stretch goal, it gives you a sense of their long-range thinking. Okay, let's dig into the more immediate stuff. How did Q1 actually look financially? And what's the outlook for the rest of the year, profit-wise?
Okay, profitability. So the full-year operating margin forecast is still holding at 29%.
Okay.
Interestingly, their Q1 operating income actually beat expectations.
Oh.
But they clarified that was mostly just timing, timing of spend.
Okay.
They expect content costs and also sales and marketing expenses to ramp up later in the year, especially Q3 and Q4.
Why then specifically?
Well, it lines up with when their biggest returning shows are slated to drop, plus they're still investing pretty heavily in building out the ad sales side.
Got it. So a bit of a timing bump in Q1, but costs catch up later. What about revenue? How much money actually came in?
Right, revenue growth. So in the U.S. and Canada, it was 9% year over year in Q1.
9%. Okay.
Now, that's actually a bit slower than the 15% they had in Q4.
Why the deceleration?
They pointed to two main things. The timing of recent price increases, and also Q4 had that boost from the NFL games they carried.
Right, the Christmas game.
Exactly. But they do expect that growth to reaccelerate in Q2. That's mainly because they'll get the full year-over-year benefit from those price hikes, plus, continued growth from advertising revenue.
And free cash flow. That's always a big one for Netflix watchers.
Yeah, they stuck to their guidance there. A pretty robust $8 billion in free cash flow expected for 2025.
$8 billion.
And importantly, they stress the goal is to keep growing that free cash flow over time. That kind of cash really gives them flexibility.
Definitely. Now, with all the economic chatter out there, it was interesting they touched on consumer sentiment. Sounds like they aren't seeing major warning signs.
That's what they said.
Yeah.
Currently, looking at things like retention, what plans people are choosing, overall engagement. No significant negative impacts showing up from the broader economy.
That's good news for them.
Yeah, and they pointed out that historically, entertainment, and Netflix specifically, tends to be pretty resilient when times get tough economically.
People still need their shows.
Right. And having that lower cost ad plan probably gives them an extra layer of resilience too.
Good point. It's easy to just think of them as a U.S. company sometimes, but they really hammered home their global presence, didn't they? Especially on the content side.
Oh, absolutely. They highlighted producing content now in 50 different countries. They see that global approach as a real strength.
50. Wow.
Yeah, they mentioned ongoing investments in the UK, that $1 billion commitment in Mexico, the $2.5 billion they put into Korean content just last year.
Huge investments.
Yeah, tangible examples showing they're serious about international markets and, contributing positively to local economies and cultures. Plus, that diversification probably helps insulate them a bit from regional economic bumps.
Makes sense. Okay, let's switch gears a bit to future strategy. Pricing. Always a touchy subject.
Hmm.
How are they thinking about increases moving forward?
They're sticking to their philosophy there.
Yeah.
Price hikes will be based on the value members perceive they're getting. It's not like they have a set schedule.
So value driven.
Exactly. And expanding the range of price points, including that ad tier, is key to that. Offering the right plan at the right price for different people.
And live events, that's still relatively new territory for them. What's the latest thinking there?
Yeah, the focus seems to be on what they call big breakthrough events.
Big moments.
Right, the kind of stuff that gets everyone talking, drives signups, maybe helps keep people subscribed to.
Like what?
They mentioned the upcoming Taylor Serrano boxing rematch and carrying the NFL Christmas Day games again in 2025.
Ah, yes.
And they said the intention is definitely to expand their live capabilities globally over time.
Interesting. And the ad business seems like a massive focus. Doubling ad revenue this year, that sounds like a tall order.
It does, but they seem confident. They're tackling it from multiple angles.
How so?
More upfront deals with big advertisers, expanding their programmatic capabilities, that's the automated ad buying, and also selling inventory closer to air date in the scatter market. And importantly, they said they're not seeing any real signs of softness in the ad market right now.
That's positive. They're also building their own ad tech stack, right? That sounds like a huge project. Why do that in-house?
Yeah, it's significant.
Yeah.
But developing their own tech gives them way more control and flexibility.
Ah.
It lets them improve the experience for the advertisers, offer more sophisticated stuff like better targeting, better measurement.
So more advanced features down the line.
Precisely. They've already rolled out their own system in Canada and the US, and the other 10 ad markets are set to follow. They really see this in-house tech as a key advantage long term.
And when you talk targeting, getting those personalized ad recommendations right must be the holy grail. Where are they on that?
They were pretty upfront about being in the very early stages there. Just beginning to get that going, I think was the phrase.
Okay, so early days.
Yeah. The first step was building the foundational platform. Now they can start leveraging all that rich viewer data they have for targeting based on, life stage, interests, even viewing mood.
Mood targeting. Interesting.
Right. They've already launched some of that, and they expect to significantly expand those capabilities through 2026 and 2027. Think machine learning, optimizing ad delivery, more advanced measurement for advertisers. Lots more coming.
Okay, switching gears again. Content. Animation seems to be a really big push for them. Why is such an emphasis there?
Well, they talked about wanting to build iconic animated franchises. They mentioned some early successes like Leo, Sea Beast, their Pinocchio.
Yeah, those did well.
But the main driver seems to be just the sheer demand. They pointed out that 9 of the top 10 streamed movies last year were animated.
9 out of 10. Wow.
Yeah, huge demand. So their strategy is a mix.
Yeah.
Producing their own original animation, but also licensing stuff from the big studios. They've got a slate of originals planned through 2027, like a film called In Your Dreams coming later this year.
It's also interesting they're looking beyond, traditional Hollywood for creators.
Yes, very much so. Actively looking for that next generation of storytellers from different platforms, different backgrounds.
Like who?
They specifically mentioned the success they've had with people like Mrs. Rachel, The Kill Tony Show, the Sidemen Group, Pop the Balloon. Examples of how premium content can come from non-traditional places and really connect with audiences.
That makes sense. AI is obviously a super hot topic everywhere. What's the Netflix take on its role in making shows and movies?
They sounded genuinely excited about AI's potential. And importantly, not just for cutting costs, but for actually making the content better.
How so?
Things like using AI for set references, for pre-visualization of scenes, or for prepping visual effects work.
Okay.
They gave a really cool example. Rodrigo Prieto's film, Pedro Paramo, used AI for de-aging effects, apparently at a fraction of the cost of doing similar work on, say, The Irishman.
Wow, that's a big difference.
Yeah. So the focus is really on improving the experience for members and for the creators they work with.
With just so much stuff on Netflix, how are they helping people find what to watch? Discovery must be a huge challenge.
Oh, absolutely critical. They pointed out that even their biggest hits drive less than 1% of total viewing time.
Less than 1%. That's nuts.
It really shows the scale, right?
Yeah.
And the need for good discovery tools.
Yeah.
So they're testing a new, simpler TV homepage design. They called it a major structural change that's rolling out later this year.
Okay. Simpler homepage. Anything else?
Yeah. They're also developing new things like interactive search using generative AI. It's constant effort, just trying to make it easier to find something good.
Makes sense.
Yeah.
And games. Still feels pretty new for them. How's that going?
They basically described it as a multi-year iterative journey.
So marathon, not a sprint.
Exactly.
Ah.
Long-term project evolving over time. Right now, the focus is on a few areas. Immersive games based on their own IP, like Squid Game Unleashed. Bringing big established mainstream titles like Grand Theft Auto onto the platform.
Right. GTA was big news.
Making kids games. They just announced a Peppa Pig game and also those kind of socially engaging party games.
So a mix of things.
Yeah. And they admit there's still lots of room to improve the user experience for gaming, how you discover games, the quality of the games themselves. Measured.
Yeah.
They'll increase it as they get more confident it translates into member value, especially better retention. But they do see a huge long-term market there, like $140 billion in consumer spending, not even counting ads.
Wow. Okay, one last area before the Q&A, those extra member accounts. Is that becoming a big deal for them?
They provide the option, for sharing, but they kind of downplayed it as a major business driver.
Yeah.
They expect it to stay relatively small.
So not a huge revenue source.
Doesn't sound like it. They see good engagement from those accounts, but it's not really moving the needle on their main growth numbers.
Gotcha. Okay, the analyst Q&A. This is often where you get some unfiltered insights. What were the key topics analysts pushed them on?
Yeah, always interesting. So content spending came up. Questions about the increased investment levels.
And the response.
Management basically said, look, it aligns with our long-range plan to build the most loved entertainment company. It's strategic.
Okay. What about member retention? Any worries there?
They reported strong and stable trends overall. Acquisition and retention were healthy in Q1. And interestingly, people who joined specifically for big events like the Jake Paul fight, NFL, Squid Game, they tend to stick around, just like members who join for other reasons.
That's good to hear for them.
Yeah, no meaningful changes in churn trends, they said.
Given the economy, what did analysts ask about the ad business? Especially with the TV upfronts coming up.
Right, they wanted to get a sense of the ad market outlook. Management sounded pretty positive, seeing good signals from clients going into upfronts, not really seeing broad signs of softness right now.
Okay.
They also sort of suggested their relatively smaller size in the overall ad market might give them a bit of insulation if things do get choppy.
Makes sense. Video podcasts are getting bigger. Did that come up?
It did, yeah. The potential for video podcasts on Netflix. Management acknowledged the format's growth, how the lines are blurring between audio podcasts and video talk shows.
So could we see them on Netflix?
Potentially. They already do audio podcasts related to their shows. They see video podcasts as a possible evolution down the line as the format matures.
How about competition, particularly from, TikTok and short-form video?
Their view is that the biggest opportunity is still capturing that massive chunk, like 80% of TV time that isn't currently spent on Netflix or YouTube.
Focus on the bigger screen time.
Exactly. And they feel their focus on premium, longer-form storytelling gives them a better monetization model than the user-generated content platforms.
And finally, any changes to how they plan to use their cash? Capital allocation.
No changes there. They reiterated their priorities. Number 1, invest in profitable growth. Then, maintain liquidity. Then, return excess cash to shareholders via share buybacks, assuming no big M&A, and finally, selective M&A, if it makes strategic sense.
So buybacks likely to continue.
Sounds like it, yeah. Seems like a key part of returning value.
Okay, wow. That really covers a lot of ground. It gives us a really comprehensive picture of where Netflix is at after Q1.
Definitely.
It's clear they're playing a long game, right? Big investments in content, advertising, exploring these newer areas like live events and games, all while, keeping a very close eye on the economy.
Absolutely. And before we wrap up, it's worth mentioning they gave a nice acknowledgement to Tim Haley.
Oh, right, Tim Haley.
Yeah, 27 years on the board of directors. An incredible tenure. His contributions were clearly significant over Netflix's history.
27 years, wow. Definitely deserves recognition.
For sure.
So, as we look at everything we've discussed, these ambitious goals, this multi-pronged strategy, from global content to ads to games, what strikes you as maybe the biggest opportunity or perhaps the most significant potential hurdle for Netflix in the next few years as they try to grab an even bigger slice of our entertainment time and our wallets?
That's the big question, isn't it?
It definitely leaves you with a lot to think about.